Investing is not just about numbers and financial statements, it's deeply intertwined with human psychology. The decisions we make are often influenced by our emotions, biases, and mental shortcuts. Understanding the psychological factors that influence our investment decisions is crucial for making sound financial choices. These factors can range from fear and greed to overconfidence and herd mentality. This video explores some key psychological concepts and how they shape our investment behavior. By delving into these concepts, we can better understand why we make certain decisions and how to improve our investment strategies. We often make investment decisions based on emotions rather than rational analysis. For instance, the fear of losing money can lead us to sell stocks prematurely, while the excitement of potential gains can make us take unnecessary risks. Recognizing these emotional influences can be the key to making better financial choices. By being aware of our emotional triggers, we can take steps to mitigate their impact on our decisions. From fear and greed to overconfidence and herd behavior, our minds can play tricks on us. These psychological biases can lead us to make irrational decisions that may not be in our best financial interest. Understanding these psychological biases is not about eliminating emotions entirely. Instead, it's about recognizing their influence and learning to make more informed decisions despite them. By acknowledging our psychological vulnerabilities, we can strive to become more rational and successful investors. This involves continuous learning and self-awareness. By integrating psychological insights into our investment strategies, we can enhance our ability to navigate the complexities of the financial markets and achieve our financial goals. Risk aversion, the tendency to favor certainty over uncertainty even if it means lower returns, is a powerful force in investment decisions. This psychological inclination often drives investors to seek stability and predictability in their financial choices. Most investors are naturally risk-averse to varying degrees. This means that they prefer to avoid the unknown and stick to what they perceive as safer options. This aversion stems from the basic human desire to avoid potential losses. The fear of losing money can be more powerful than the excitement of potential gains. Investors often opt for lower-risk investments like bonds or fixed deposits. These instruments are seen as safer because they offer more predictable returns. They do this even if these offer lower returns compared to stocks or real estate. The trade-off is clear: safety and stability over potentially higher, but uncertain returns. This is a classic example of risk aversion at play. The decision-making process often involves weighing the comfort of security against the allure of higher profits. While risk aversion can help investors avoid significant losses, it can also hinder potential gains. Playing it too safe might mean missing out on opportunities for substantial growth. For instance, an overly risk-averse investor might miss out on the higher returns offered by growth stocks. These stocks, while more volatile, have the potential to significantly increase in value over time. Finding the right balance between risk and return is crucial. A well-balanced portfolio can help manage risk while still providing opportunities for growth, ensuring that investors can achieve their financial goals without undue stress. Overconfidence, the tendency to overestimate our abilities and the accuracy of our predictions, can lead to disastrous investment decisions. Investors often fall prey to the illusion of control, believing they can predict market movements with greater accuracy than is realistic. Overconfident investors may trade excessively, hold concentrated portfolios, or invest in speculative assets, all of which can lead to significant losses, especially during market downturns. For example, an overconfident investor might invest heavily in a single stock based on a hot tip. They ignore the inherent risks and fail to diversify. Excessive trading driven by overconfidence can also erode returns due to trading fees and the tendency to buy high and sell low. Loss aversion, the tendency to feel the pain of a loss more strongly than the pleasure of an equivalent gain, is a deeply ingrained psychological bias that can significantly influence our financial decisions. This bias is particularly evident in the world of investing, where the fear of losing money can lead to irrational decision-making. Investors often hold on to losing investments for too long, hoping to avoid realizing a loss. This behavior is driven by the hope that the investment will eventually recover, even when all signs point to the contrary. Conversely, they may also sell winning investments too early to lock in profits, fearing that the market will turn against them. This premature selling can prevent them from maximizing their gains. This behavior, known as the disposition effect, can significantly impact long-term investment returns. By selling winners too soon and holding on to losers for too long, investors can undermine their overall portfolio performance. For example, an investor might hold on to a declining stock hoping it will rebound, despite evidence suggesting otherwise. This can lead to substantial financial losses over time. They refuse to accept the loss even if there are better investment opportunities available. This stubbornness can prevent them from reallocating their resources to more promising investments. This fear of loss can lead to missed opportunities and limit portfolio growth. By understanding and addressing this bias, investors can make more rational decisions and improve their long-term financial outcomes.